Last month, you predicted the Federal Reserve would cut interest rates thanks to falling inflation. But today, data showed that inflation rose more than expected for the third straight month. So how concerned are you about the fight against inflation stalling? And do you stand by your prediction for a rate cut?
Well, I do stand by my prediction that before the year is out, there'll be a rate cut. This may delay it a month or so. I'm not sure of that. We don't know what the Fed is going to do for certain. But look, we have dramatically reduced inflation from 9% down to close to 3%. We're in a situation where we're better situated than we were when we took office, where inflation was skyrocketing. And we have a plan to deal with it, whereas my opposition talks about two things. They just want to cut taxes for the wealthy and raise taxes on other people. And so I think they have no plan. Our plan is one I think is still sustainable.
Coming up today, inflation comes in hot, sending bond yields spiking and stocks dropping, putting Jay Powell in a very tough spot as Biden is still calling for rate cuts today, even though the next move should be higher, and I'll show you all the knock-on effects across global financial markets. And surprise, surprise, inflation came in hotter than expected. Who could have seen that coming? Headline 3.5% year over year for the month of March, significantly higher than the 3.2% print we got in February. Core inflation coming in hotter than expected, and same with both month-over-month readings. And it's not so much that it was a huge beat today, as any one-off report may not mean a whole lot. It's more that it's cementing the narrative that inflation is not coming down, now that we've got the fourth consecutive beat on expectations for inflation. And just like anybody can see in this chart here, inflation is curling higher, and if we take out that 3.7% print we got back in October, that'll be a higher high, and then inflation will officially be back into an uptrend. And there's a look underneath the hood of what's driving inflation currently, with the 12-month change being led by auto insurance, rent, housing, restaurants, personal care, and we're starting to see energy creep back up in there, whilst we're seeing a bit of disinflation in rental cars, toys, airfare, appliances, and furniture. So non-necessities. And so the market's completely flipped. You remember yesterday, Fed Fund futures were pricing in a bit over a 60% chance they were going to cut in June. That's been pushed all the way out to September. A big material change in the pricing of interest rate cuts this year. We came into this year market pricing 6 or 7 cuts, taking us down to about 4% come end of year. Now the market is actually only pricing in 1 cut, which we may not get at all. And that's why we've seen that huge move higher in bond yields. And this really isn't good news for the Fed or Jay Powell, who so desperately wanted to see a 2% handle on inflation so he could go ahead and please his political masters and drop interest rates. However, that's going to be too much of an obvious political maneuver for him to go ahead and do that right now. And let's not forget, the Fed is largely to blame for this inflation that we have at the moment, keeping rates at rock bottom lows, flooding the system with liquidity, and still not dialing it back, even though they've had plenty of opportunity to do so. Risk assets trading at all-time highs, plenty of liquidity in the system for them to sell into. However, looking at the chart here of their balance sheet, they're only letting their securities mature and run off the sheet, opposed to doing much selling. That's why their balance sheet's still at 7.4 trillion, almost double where it was prior to COVID, 4.1 trillion. Still a heap of liquidity in the system, and they're wondering why inflation's not going back down to 2%. And so to use an analogy of embedded inflation, you could think of it as like gaining weight. And so you could think of it like this: before COVID, the economy weighed around 250 pounds of inflation. Now it's put on 60 pounds of weight, and even though the rate of weight gain is slowing down, still well above trend. Got that embedded inflation. A lot of our products and services are 30% higher from just prior to COVID, even though most people's wages and salaries are still relatively same, maybe only a little bit higher. And so in a normal logical world, you should not only see the Fed hold rates for high, if not hike them, to get on top of that embedded inflation, but also increase the pace at which they reduce their balance sheet. That's the trillions of dollars and artificial money they've created out of thin air and pumped into markets. However, they're signaling that they're actually going to slow that. Currently been reducing it by about 95 billion a month. They want to cut that down. In other words, they want to keep this system propped up with liquidity. They're too afraid to let free market capitalism do its job, and they have to constantly and artificially tinker with things, even though we've got signs of structural inflation more to come looking at the price action in commodities, and other less known measures like super core inflation, which measures services inflation excluding food, energy and housing. That's up 4.8% year over year in March and is currently running at an 8% annualized pace. And we can see that in this chart here, significantly turning higher compared to headline inflation that most media outlets are reporting on today. And so it's services that are really keeping inflation up. We had been having some disinflation in manufacturing, that's also turning back up. But just looking at CPI, consumer services less rent of shelter, annualized rate 8.68%. And so we're at a bit of a fork in the road in financial markets. Because logic says we shouldn't be thinking about even talking about rate cuts anytime soon. There's absolutely no reason to be cutting rates right here. However, we've got to remember this is an election year. Politics rules supreme. Biden administration wants to get re-elected. They, along with Congress, have oversight and control of the Fed, and they're not all too concerned with structurally high inflation or wanting to get it lower in the future. That's why we've still got Biden saying today, even after this latest inflation print, he still sees a rate cut before the end of this year. And high inflation is bad for Biden and his chances of getting re-elected. He'd really love to see the Fed cut rates at least once before November to help out American consumers. He'd love oil and gas to be low going into November as well. However, it's thanks to the federal government, along with the Federal Reserve, as to why we've got this big inflation. On top of years of really loose monetary policy coming out of the Fed, we've also got really loose fiscal policy with record amount of spending that has helped drive a lot of this inflation as well. And it's not only the Biden administration wanting to get re-elected, there's other concerns as to why Jay Powell wants to cut rates as well. That's to allow the Treasury to refinance a huge amount of debt because the interest expense on US public debt is exploding, currently at $1 trillion, and the picture's getting more dire by the day. And so just keep in mind, the US government made $4.4 trillion in revenue tax receipts last year, and so their interest on their debt is now over a quarter of that. And by some measures, even if rates weren't to change, that figure's going to approach half. So to put that in context, imagine you made $100,000 a year. You're currently paying $25,000 interest every year, and that could go up to $50,000 in the next couple of years. It's not a good financial situation to be in. And that's why we've already got bond investors shying away from auctions. We've seen more and more signs of weak demand for US government bonds, with the weakest participation in the auction today since November 2022, forcing Treasury dealers, who are mostly large US banks, to absorb far more of the debt auction than usual. So that hot CPI print, along with weak demand for Treasuries, is why we got the biggest move today coming out of Treasury yields. And we can see that on this explosive move in the short-dated 2-year yield, up a whopping 23.5 basis points, exploding higher, almost back to a 5 handle. Same with the 10-year, up about 18 basis points, now back above 450. And again, remarkably, stocks held up pretty well. Looking at the S&P 500, closed down about 1%, briefly dipped below its 50-day VWAP, actually a bit of a flight to safety. To the Magnificent 7 stocks, as a group finished higher. It was really small caps that were hit hard today, down 2.6%. On volume, the VIX popped up as well, now sitting just below 16, and option dealers continue to ask for more premium over realized to write contracts in this market. And it was definitely a case with the market pricing in higher yields today. We can see that in the price action of sectors. REITs getting hit the hardest, down over 4%. Next up, utilities, materials, discretionary and financials all coming off today, whilst it was actually energy finishing a bit higher. And just looking at the sector trends table indicator, we've now got the Dow and the Russell underneath the 50-day moving average, along with consumer discretionary stocks and healthcare and staples, showing that there's not really a defensive move in this market, but more a rotation into inflationary assets like oil, gold, and energy green across the board. Now got the dollar index green across the board and inflation expectations as well. And technically speaking here, S&P 500 is changing its tune a little bit. Ever since we topped out on the 21st of March, done a bit of a divergence. And like I said back here, this big bearish engulfing candle can have meaning, as engulfing candles are one of the most high probability patterns on the chart, and they can have a little retracement and pullback, and looks like we've followed through a bit on that today. Lower lows, lower highs, and we've just taken out some key support in the bond market as well. TLT falling down on volume, and high yield bonds as well, slipping below this support zone I've had in here for a while, with a really strong move up in the dollar index. And we could be just getting started, as we'll get a look at the producer price index PPI data tomorrow. Along with CPI, that's likely to push up the Fed's preferred inflation gauge of personal consumption expenditures, PCE, which we'll get a look at later this month. And so like the former US Treasury Secretary, Larry Summers, who now can freely speak his mind, says it's a serious possibility that the Fed's next rate move is a hike. And like I said, logically speaking, that's what it should be. However, that's really going to upset the Biden administration and the US Treasury's chances of refinancing a record amount of debt. And that's why Jay Powell is now in between a rock and a hard place. And it'll be interesting to see next time we hear from him if he can keep towing this dovish line and talking about 2% inflation whilst keeping a serious face. Because on top of record government spending, huge amount of Fed liquidity still in the system, now we've got leading inflation indicators, commodities, on the march higher. Oil holding up there, above $85 a barrel, along with other commodities held up really good today, considering that huge move higher in yields and the dollar. Normally, that would send commodities sharply lower. However, we've still got a fluid situation over in Israel and Iran. Increasing demand coming out of the States and China. Supplies coming off a little bit. And we just got news of another Israeli airstrike, this time killing the 3 sons of the billionaire Hamas political leader, who's saying there's very little chance of a US-led ceasefire plan. And we've also got investors around the world starting to wake back up to gold and get back in, even though gold ETF assets under management still well off their highs from late 2020. And there's a look at gold futures today. Came off a little bit, but like I said, held up really good considering that strong move higher in the dollar and bond yields. However, we should expect a bit of a short-term pullback here. Wow, looking a little extended. Almost 9% above the 50-day VWAP, which is a pretty big move for gold. Silver as well, maybe due a little pullback. However, we still have plenty of trend in the precious metals, along with crude defending this $84 level that was prior resistance. And agricultural commodities still on the march higher, breaking out again today, and the price you pay at the pump still hanging in there. And just moving on from inflation and commodities, looking at what else is happening across markets today. As I was talking about yesterday, we've got the trend of large tech companies wanting to take more ownership of their supply chain. We saw that again today with Meta Platforms unveiling its second generation AI chips like Google, Apple, and others looking to make their own chips instead of relying completely on NVIDIA. And there's a look at Meta today, actually closing higher, along with NVIDIA after we got a bunch of analyst upgrades, just trying to hold its 50-day here. Definitely lost momentum over this last month or so, and Apple continues to look weak, sliding again today, now testing this support zone along with the ever volatile Tesla. And Q1 earnings season has officially kicked off with Delta Airlines coming out today with record revenue as business travel accelerates, which initially gapped the stock up, then actually finished lower. They did come in with a pretty good beat, 21% higher than expectations, and the airline companies have been holding up pretty well in the face of the price of crude going up in that time. But the most important ones are the big banks, JP Morgan, Wells and Citi, kicking off earnings this Friday. We'll get a taste of what's to come. And a bit of a material change in the mood today. Got the greed index pulling back to neutral, corporate insiders not doing a whole lot of trading, and a material change in the options market as well. Huge amount of volume and Tesla put options, 2.8 billion notional. A few more puts going on the S&P 500 and in other popular traded assets as well. Apple, Nasdaq Qs, Boeing and the Russell. Way more put option action happening. And it was a busy day in the options market. 42 million contracts traded and we came in equal amount of puts and calls for a change. Short-term breadth dived today. Only 33% of stocks above their 20-day average, even though we've still got more than half above their 50-day. And a bit of a move higher the amount of stocks making new lows versus new highs, especially so on the Nasdaq, actually breaking out 103 stocks making new lows today. Still got a little backwardation up the front. In the VIX term structure, market may be priced in a few more moves tomorrow in the back of PPI. And there's a spread of commodities versus stocks continuing to push up here, especially in gold versus the S&P, and even more so and gold versus treasuries. With the 10-year, 2-year bond curve moving back down deeper into inverted territory, and no surprise, the spread of inflation expectations breaking out again today. In addition to REITs, we also have got one of the hottest leading sectors over the last year, home builders, losing the 50-day today on volume, as they too are sensitive to yields, and regional banks really not liking that move higher in bond yields. Down 5% as a group going into their earnings season. And there's a look at REITs. Bit of a material change in price action there today, along with dividend stocks also coming off pretty hard. Meme stocks didn't like that move in rates today either. Bit of hot money coming out. And the stock I brought to your attention yesterday, A-Mark Precious Metals, which you could think of like an exchange for gold and silver, which even though the underlying pulled back today, the stock was up 5.4% as they benefit more from trading and volume. And this is a really explosive price action move we've got the last few days. Another momentum upward thrust on really strong volume. This stock is trending. And interesting, we've still got aerospace and defense stocks still holding up there pretty good, holding trend, and some pretty significant moves lower in the financial sector today as we have a changing narrative in this market when it comes to rates. All right, guys, there we have it for this interesting Wednesday in markets. Bit of a pivotal moment, I would say. Kind of cementing the narrative that inflation is not going back down to 2%. And like I've been saying for a while, the ingredients are all there for a resurgence in inflation. Amount of liquidity in the system, government spending. Even though the Fed did do an aggressive rate hiking cycle, it wasn't enough to topple the economy into a recession, spike unemployment, and bring inflation down. They refuse to reduce their balance sheet anywhere near to pre-COVID levels. Government spending at records. geopolitical tensions, rising commodity prices, it's really not all that surprising. We're getting upticks in inflation, and this could be only the beginning. We may be on our way back to a 4 handle on the CPI in the next month or two, in which inflation will officially be back in an uptrend, and that's going to be a real test for the stock market, which has pretty much rallied up ever since Jay Powell said we're going to cut rates, and the market was pricing in 6 cuts. Now, like I just showed you with Fed Fund futures, luckily if we're going to get 1 cut this year, and what a move in the bond market we got today. Just absolutely sold off as yields spike right in the face of what the Fed and the Biden administration wants to do, whilst we've still got inflationary assets of crude oil and gold ripping higher. Thanks very much for tuning in to the Click Capital Daily Market Review. I appreciate all of you that hit that like button and drop a comment, and I look forward to bringing you another video tomorrow after we get PPI. Thanks very much, guys, and I'll see you then. Cheers.